who is present. I do trust you can hear my voice. Please issue a confirmation before we can start.
Morning, Cynthia. We can hear your voice.
Thank you very much, Martin. So allow me to put on my camera just so we can put a face behind the voice, and thereafter I will beg to turn off the camera just so I can have stability too on my internet. So good morning, everyone. It is a pleasure to have you all. My name is Cynthia Orangi. I work for APA Life. I sit within the pensions department. I champion client relationship as well as the pension administration. So thank you very much for making time for us. It is a very chilly morning, but we hope the conversation today will warm the day up. We are set to have a very intense conversation. It is something that is close to our hearts. And we invite you all to follow along. And we also invite you to make this meeting as participative as possible. Before we get into the various presentations, we welcome you to utilize the chat box and the Q&A section. If you have any questions, feel free to channel the same, and the various panelists will be at hand to address your queries. So thank you very much, and allow me to make my introductions. And before that, I will invite the other panelists to introduce themselves. We can start with Mr. Paul Moi and then move on to Mr. Martin Mathai.
Good morning, everyone, and it's a pleasure to be with you this morning in a very chilly and cold morning in Nairobi. And thank you for joining us. My name is Paul Moi. I am the CEO of Apollo Asset Management, looking after the investments for the group and also for a lot of external clients and managing our money market fund. Thank you.
And happy morning, everyone. Welcome to this webinar. My name is Martin Mathai. I head the corporate section for Life. And today we're going to talk about finances. So you're welcome and enjoy yourself.
Thank you very much, Paul and Martin. So again, once again, good morning, everyone. It's a pleasure to have you all here with us. As the other panelists have mentioned, today we shall discuss a topic that is at the heart of our everyday lives, and that is financial wellness. And we are in the Valentine season, and we are going to talk about something that is more often than not overlooked. And if you agree with me, most of you I know will, and is that love and money go hand in hand. True love is not just about grand romantic gestures, it's also about making the right financial decisions for yourselves, for your dependents, and for your loved ones. And because when you secure your financial future, you're not just protecting your wealth, you're also protecting the people who matter the most. So which is why we are having this conversation today. We want to go beyond exploring the fact that money is just not about numbers. It's about security, it's about freedom, and the ability to live your own life under your own terms. So today, we hope to empower you with knowledge and tools to make confident financial decisions. And hopefully, when we adjourn for this meeting and as we move on to attend to other matters of the day, we hope that we shall be more financially savvy. So allow me to introduce who we are. As you can see on my screen is that we are APA, the Apollo Group, and I will walk you through who we are, what we do, and the other panelists can join in and carry the conversation along. So as APA Apollo Group, we are a trusted leader within the financial industry. We offer a wide range of solutions tailored to protect, grow, and maximize your wealth, be it on retirement planning, be it on investment solutions, be it on insurance products, be it on savings plan. We help you basically build a financial cushion for the future. So allow me to move my screen and walk you through the very first part of this presentation. So this is a snapshot of who we are. On my very left, that is the left side of the screen, we are displaying who our shareholders are. We have Swiss Re. This is one of the largest reinsurers in the world. We also have Kenmark, which is the founding shareholder. We have Pollard International. They came in around October of 2023, and we also have Apollo Investments, which is the holding company. To my right, rather to the right of the screen, we have the various subsidiaries and the various businesses they deal in. Our presence is felt in Uganda through APA Insurance. They offer the general insurance and health insurance solutions. In Kenya, we have our asset company. This is the Apollo Asset Management, who deal in asset and wealth management. We also have our property manager, that is the Gordon Court. We have APA Life, where we house the life insurance products as well as the pension solutions. We also have APA Insurance in Kenya. They offer the general and health insurance solutions. In Tanzania, we have a footprint through Reliance Insurance, and they offer general insurance as well. And our very last one, if you allow me to say that, is the APA Microinsurance, which is currently in formation, which we would basically deal with the SMEs and basically offering insurance to the small and medium enterprises. So to move on, this is an extrapolation of who we are. Like I did mention, we are one of the leading financial services providers in East Africa, offering various solutions that is bordering along retirement planning. This is for the retirees, just so you can enjoy financial securities in your golden years. We have investment solutions through our asset company. This is basically making your money work for you. We have the various general and health insurance solutions that basically safeguard what matters most to you. And of course, we have the various savings plans to help you build a financial cushion for yourself. So APA Insurance is a subsidiary of the Apollo Group, and it is the second largest general insurance by market share in Kenya. So like I did mention previously, as of October of 2023, we had the Hollard International taking up a significant equity stake in the Apollo Investments Limited to basically solidify our role as being the second largest insurance in the group. So together with Hollard, Swiss Re, and APA, we are poised for growth, driving innovation, expanding our product offerings, and enhancing the customer experience across Kenya and other 10 African countries. I'm advised my screen is not visible. So allow me to reshare again.
Cynthia, it's visible, you can say.
It's visible?
Yeah, just
okay, thank you. Thank you. Okay, thank you for that. So to touch on our regional presence, we have a presence in Kenya, Uganda, and Tanzania through the various subsidiaries I did mention on the very first slide. We serve a customer base in the excess of 183,000, and this number keeps growing by the day. We have around 13 branches in Kenya, 6 in Uganda, and we have 8 liaison offices through which we can interact with the various customers who want various solutions that we offer. Driving this and the various products we offer, we have a staff base of around 500. So rest assured, we will be at hand to offer you assistance and service as and when you need the same. So to move on, what is our mission? What is our vision? What does our brand speak about? We put smiles on the face of our stakeholders. As if you look at our logo, and that is the smiley face, we basically ensure happiness, and we want to basically give products that meet the need as per what you, our clients, want us to basically serve you. And we are one of the region's most respected group. We create and protect wealth. In terms of our asset company, it is investing in happiness. In terms of our brand personality, what sets us apart from other people or other competitors is that we are sophisticated in the way we do our things. We are excited when it comes to our service offering, and we remain competent in all our service offerings. So we shall be moving on to the next part of this presentation, and allow me to basically invite the next speaker of the day. We are going to have a conversation as to why financial wellness is an essential part of the journey towards creating financial security. And we want to dive deeper into the different stages of life and what to expect Our needs and priorities shift as we grow, and we want to understand those transitions when it comes to making informed money decisions. To take us through this part, I'm pleased to introduce Martin. He is the head of our corporate business at APA Life. He has extensive expertise in financial planning and corporate solutions, and Martin will walk us through the different life stages, what we should consider at each step to secure a future, and to basically walk us that journey. So Martin, over to you. You can carry us through the next part of this presentation.
Thank you, Cynthia, and what an introduction. Well, let me first start by thanking everyone for joining this particular session. As you heard, my name is Martin, and what I will take you through is the next 2 steps is basically about financial wellness. I know we talk about health and we talk about wellness in general, but what does it mean to be financially well? Does it mean that you have to have a lot of money, that you're okay with life? Is that basically what financial wellness is all about? Well, let me demystify that in a few seconds. If I can go to the next slide, Cynthia. If I was to ask you this question, probably you could text me if you are online, you could on your chat, and just tell me what you think about it. But interestingly, when you think about financial wellness, there are things that you have to consider. One is that it's a state, basically. And a state means it is a point in time of your life where things are basically working for you. So it's a state, it's not a permanent place. So one day you may not be financially secure, the other day you may be very secure, but the aim is to ensure that at least we try to be financially secure. So what are these things that we're looking at first? So at that particular state of financial wellness, here you have a full understanding of your finances. When I say so, I mean that you know how much you're earning from, let's say, your employer, from your businesses, from your investments. So you know exactly how much is coming in, but also in the same breath, you know what is actually going out. And you're able to track your spending. I think this is one of the biggest things that if you are able to understand where your leakages are, then you are able to manage how you are going to live and live comfortably. The other thing is at a state of wellness is that you are able to meet the current obligations that you have. So you can comfortably pay your bills and cover your essential expenses. Keyword is essential. In a world right now where there's a lot of social media, there is a lot of peer pressure or pressure to basically live another life. So as long as you're able to take care of your bills, as long as you're able to take care of the essential expenses, that is one of the key items of financial wellness. The other is basically you need to make sure, you're financially secure about your future. And your future is not just a month or 2 months from now. Usually I'd say that one is that by end of this year, in about 330 days or so, we'll be talking about Christmas, and then January comes and everybody sings January. No, you should be able to be very secure about what's going to happen in your midterm, what's going to happen in your long term, and basically what's also going to happen in your medium term goals. So basically, as long as you're able to take care of your future and you're confident that you have the ability to achieve them, that is one of the things that you will actually say, I'm financially well off. And then the last thing is that you're able to make choices that allow you to enjoy life. Now, tomorrow is Valentine's, and incidentally, this conversation started off as a Valentine conversation, where people start feeling anxious, or probably some will feel guilty, they have overspent. It just basically tells you that at that particular point, if you're feeling anxious, probably you're not financially well off. So what you need to do is to make sure that whatever your life is, at least you can be able to spend and spend without feeling anxious that I'm actually spending rent money or school fees money or money that was supposed to go through an investment or money that was basically designated for a certain issue or need. So those are the kind of things that you need to think about. So when I talk about financial wellness, it's basically a state that you're able to take care of what is coming in, what is going out, how comfortable you are in terms of paying your bills and your essential expenses, how to take care of your financial future, including your retirement, because that is also very key as part of your goals. And lastly, is that you're able to spend your money right now without feeling anxious or guilty that you have spent so money. So to get to this particular state, there's a lot that happens. It just talks about there's an ecosystem of items that you'll be thinking about. One of them is income management. Income comes from all sources. There is passive income, and there is basically what you call non-passive income. And your non-passive income is basically your wages and your salary. Passive income is income that just generates from your investments, what you have been doing, your rental incomes, probably, or your investment that you have been having in terms of bonds or money markets, which Paul, I'm sure, will talk about slightly. Then also investment management. Ideally, is it from all your revenue that you receive in a month, you need to put aside something for your investment, and you need to put aside something for your savings, and need to ensure that both of them do work for you in the future. As such, when I talk about savings and investment, those are two different things. One is that savings, it's a nest. It's a saving nest or a safety net for you to ensure that in case of anything, COVID taught us a lot. COVID taught us that in case you don't have money in your account sitting somewhere there or in some investments that are easily liquidated, then you may struggle in life, because jobs do come, jobs do go. Businesses do have some peaks and also some troughs. So generally, that's what you actually need to think about when you're talking about financial wellness. So it's income management, it's investments, what you're investing in, when you expect to get out, get in. Those are the kind of things that you have to consider. Also, savings. Savings basically here, it's an emergency nest. It's a nest to take care of the unforeseen that can happen. Of course, debt management. Debt is the biggest actually detractor to financial wellness, because when you get yourself into too much debt, at a point in time when you are very well off, when you're thinking about, basically, let me say your stability, you're financially stable at that particular point, and then you get yourself into debt, debt can actually ruin you, and especially what we call short-term loans, mobile loans, and items like those ones. Of course, retirement planning, because at the end of it all, when we generate revenue, we generate wealth when we are of good and sound bodies. As we age, we get old. Some of the things that we are able to do now, we are unable to do in our future. For some of us who are employed, at some point in time, the employer will say that now you are no longer of age. You have to retire because you have hit a certain age. So what do you do next in terms of retirement planning? So that is key. Where you're going to live after retirement, how you're going to live after retirement, should be some of the things that you need to consider when you're thinking about financial wellness. And lastly is legacy and estate planning. Interestingly, being Africans, we don't like talking about death. It's taboo. However, we know for sure that in case we leave this world, and by the way, the only two things in life which are sure is death and taxes. So death basically has to be taken care of in terms of how is my wealth going to be distributed once I am not here. For what I've worked so hard for, how is it going to get to my next of kin, my family, and the rest, and any ventures that you may want to give people to. So that is estate planning. How do I make sure that I leave a legacy in this earth, and how do I distribute my wealth? So basically, that is the ecosystem when it comes to financial wellness. So ideally, everybody should think about those particular items. But there are things that happen to us because we move on from one stage to the other stage. We started off in our 20s to 35, and here is where probably started off our careers, our businesses. One of the biggest challenges that you find in this early adulthood stage is that we don't have as much money. So we get ourselves into debt. By the time you're leaving probably campus, you already have a help loan standard that you need to pay for. By the time that probably you're starting off your career, your business has not yet kicked off. And generally, you are somehow in debt. In these ages of between 20s and 35 is when you're starting out in life. Families, children, probably at this age, they started going to school, and what you realize is that your disposable income tends to reduce and is not as much compared to later on in life. So definitely there are some opportunities and also some pitfalls that can actually make your financial wellness in these particular ages a bit shaky. Lifestyle also matters, and especially as you are in your younger self, before you realize and determine where your life needs to go, a lot can happen. We usually joke at these ages between 20s and 30s is when we get our first cars. For men, usually that blue Subaru. For ladies, I don't know whether it's a Demio now or an East. Maybe someone can just tell me what it is. But anyway, what I mean is that lifestyle, you're influenced by lifestyle of us and others. The phones that we have, communication gadgets, they stop being communication gadgets, start being items of statement. So these are the pitfalls that actually can challenge financial wellness in your early adulthood. Now, the other thing that I would say is that when you get to your mid-adulthood, and this is between 35 and 45, for people who are working, for people who are in the businesses already, you become an expert in this particular field. So your disposable income is a bit high, but that income that you're generating, which is higher than your early adulthood, is actually gets competing interest. And some of the competing interest is at this particular age, probably you're thinking about home ownership. Your living expenses tend to be high because now you have a family, you're paying school fees. There's debts that you are probably accumulated when you were young. And young would mean that probably the first car, the first house, the first piece of land that you're buying, all those are debts that you actually got yourself into. And hopefully it's a good debt, because there are two types of debts. There is a good debt, and there's what you call the bad debt. Bad debts are debts that are taken to take care of living expenses. I'm traveling to Mombasa over the weekend and I need to have a good time. So I'm going to take a debt on it. That's a bad debt. School fees, also you have to think about it because and plan for it. In fact, incidentally, before our children go to school, probably they take about 3 years to 4 years. So at that particular stage is when we should be saving for them and also taking care of them. I used to work for an employer where we had a SACCO. And one of the biggest loans that we had was an emergency loan being taken for a child going to high school. My child has gotten to Form 1 and they want to go to high school. I need an emergency loan. So our employees would tell us that I cannot give you an emergency loan to take care of school fees for a child who you have been with for the last 14 years. So you have to plan for it. So ideally, at these particular ages, is you have to plan for school fees, you have to plan for how you're going to get rid of your debt, reduce the debts that are unnecessary. You have to think about your living expenses. Also, school, where you take your kids to school also matters because some of the biggest expenses that you find in our lives could be related to the schools that you're taking our kids to, or just basically the lifestyle that you're living in and the kind of needs or wants. Actually, the wants are the worst when it comes to wants that are not generally needs or should help in your life. Of course, at these ages, you have to think about what happens if I'm not there. Investments, basically, and also savings. In case I lose my job at this particular point, like I said, we probably have done quite a number of years by the time we get to 35 as supervisor or mid-level management. So ideally, there could be uphills and downhills when it comes to these employers. So you have to think about your safety net, that the family that I have, in case of anything happening, what happens to us? What happens to them? Am I able to take care of? Am I able to take care of our living expenses? Am I able to take care of school fees? So those are the things that you have to think about when you're looking at that middle adulthood. The other thing is insurance, that in case I'm not there, what happens to my family also? This is key because you need continuity of what you're providing for your family. I give a simple example. If in my house, every month I bring in about 50,000 shillings or 100,000 shillings, just give and take. Let me use 100,000 for ease. And that is the revenue or salary or income that I bring in from my activities. So in case I'm not there, I will know that the family will miss out on 100,000 shillings every particular month. So what do I do with regards to taking care of them, and how long will it take my spouse for her, for example, to stand on her feet and be able to generate adequate revenue to take care of that? So if I give and take and say probably 3 years, so I will look at my 100,000 shillings that I bring in and multiply that by 12 months, which would be 1.2. then multiply that by 3 years, which will be 3.6 million shillings. So ideally, the basic thing I should take is a life insurance cover that covers me and my family for the next 3 years, which will be 3.6 million shillings. So that will be my sum assured. So that's why insurance is key when we are at these particular ages, because either the children are too young still, so there is a long time to when they finish university. So definitely you have to think about how the school fees will be taken care of. So insurance covers are almost a necessary need in these particular ages. Of course, your retirement is coming in 35 to 45. For most employers in this country, it's after 55. You find that you are now eligible for retirement. So literally, you have to start saving for your retirement. You have to start thinking about how you're going to live after retirement. You have to start thinking about where you live after your retirement. So start making small steps towards your retirement planning. When you get to 45 years and above, what you call almost late adulthood, so this is the time when most of us are saying that, okay, now I've done enough in terms of my employment. I want to retire at the age of 50. I want to, probably my children are already at a certain age in the secondary school or high school, or probably some in the universities. So at this age, you'd want to basically clear off and make sure that all your debts are at the minimum, if possible. What you have been holding as a long-term debt, you should fast track to make sure that at least say gotten rid of. The same thing with the amount of money that you have been using to pay off the debts. You need to look at it in terms of investments and push it back to investments and also savings. And retirement should be priority in terms of this particular discussion, because now at these ages, it's what am I going to do after my retirement? Am I going to live after my retirement, which is very close. So having a good retirement plan is proper. I know most employers right now are required to contribute to NSSF, and we have seen quite an uptick with regards to NSSF contributions. But NSSF will not be adequate for you if you start contributing from your 35s and above. So ideally, it should be adequate when you're in your early adulthood. So that means that you have to basically, what you call it is you have to augment those particular contributions to NSSF by having another retirement plan where you save extra. You may be lucky that an employer is contributing for you. The more you contribute, the better it is for you at retirement. So ideally look at it from that particular perspective. Health is very key at this age. So one is that ideally, this is when health issues check in if you had been living a poor lifestyle before your 40s, your mid 40s. So the lifestyle diseases check in, but there is always a chance to make sure that you have a turnaround by living healthy, by taking care of yourself, by going for annual medical checkups for ladies and also for men. Because this basically will help you in terms of identifying any issues that may have cropped up in the last couple of years. Incidentally, when we talk about medicals, our company offers some medical insurances, and one of the benefits they usually do give is a checkup. I'm sure within your insurance, medical insurance, you can probably ask about that checkup. It's important because it will help you with regards to your life and managing your life a bit better. In fact, quality of life becomes better when you get to arrest some of these things a bit earlier. Last on that age group is school fees and college. At these ages, probably your kids are towards university, finishing university. Some of them are just about to clear high school, hopefully. And my prayer is that at this age, we're not starting again, because these ones become your pension children in later on in your life. So school fees and a college plan is actually very much adequate. It's very key because that can actually destabilize you towards the end of your career, where you find that you get yourself in debt just when you're just about to retire, because cost of university, cost of probably finishing school after, finishing school fees after you have retired is also key. Last age group is people above 56, because at these ages, it's you're looking at now settling down and relaxing, probably getting out of the hustle and bustle of this life. So one of the, ideally, some of the things that should be happening is that you should be drawing down from your investments that you've done over your life. So the investment should be maturing in one way or the other, or probably now this is when a bit things are, you can be able to say that I can get a paycheck from the investments that I've been doing over the last couple of years of my life, because I've been working. Hopefully now it's time for them to start paying you off. Retirement is also key, because now at this ages it's the crunch time. So it's not actually crunch time, it's actually when you're supposed to implement your retirement plans. If you are willing to be retiring out of town, probably construct or make sure that the house is up by the time you're retiring, including as such. Ideally, by the time you're retiring, you have talked to your HR, talked to your pension provider, know the options that you have for as an individual towards my retirement. Essentially, what is it that I need to do now to make sure that I have a comfortable retirement? And those are the things that would be asked at these particular ages, and this should be part of your annual checklist, henceforth from the ages of 56. Now, health insurance is key. Note that if you try to get health insurance after the age of 60, it becomes a challenge. But if you're already existing member in a health cover, then it becomes easier for you to continue. So it is advisable that at these particular ages, you plan one for yourself and get into it. Of course, estate planning, something that you should have started off a bit earlier is, you know, how your estate will be distributed, have a will. As much as we don't like talking about it, a will is very important. Consider downsizing. I usually say some of the biggest houses you see in this city are usually owned by people who, are constructed usually by people who are in their late 60s, 50s. Then incidentally, your child start leaving your house. So by the time you're in your 56, hopefully your kids are in university. Some of them will not even be in the country. So I'm left with my 5-bedroom house or 7-bedroom house with my spouse, who we expected to be cleaning that house probably on a daily basis. So some of the things that you need to think about is, should I start downsizing? Should I actually look at living in a place where there's less this monthly pay that is usually done by estates. As in, like, some of those things that you need to consider by the time you are getting to your retirement age, or the ages of 56 and above. Where am I going to retire is key at this particular point. You should have known. It's key that you keep visiting those areas often, so that at least you get some companions, because these are the people that you will live with after your retirement. Another thing that you probably would need to consider at the ages of 56 is a good health cover, how I'm going to take care of my children who are in a certain age. So all those things are the things that you need to consider. One last thing that people usually get themselves into, and incidentally, the Retirement Benefits Authority just issued a survey actually about 3 days ago or something, when they were saying that 8 out of 10 adults above the age of 50 are taking care of children, and or they have dependents who are dependent on them even after retirement. 8 out of 10 adults. So that talks a lot about how we should be able to take care of our children, how we're bringing them up so that they can be independent. Now, when you have children who come back home after they have left, we call them rebound children. Those kids should be able to stand on their own. They should be able to take care of their own life and stop relying on you, because very soon when your income stops, then everything becomes, then you get into a haywire situation and it becomes a nuisance, especially when you're dealing with children who have refused to leave your house. So definitely, there's a lot to think about. All these stages, there are opportunities and there also are challenges that may abide. The opportunities that you find after the age of 56 are many, because by the time I am hitting that age, I'm an expert in whatever I am doing. So you could have other revenue streams. You could have coming in, say, for example, as a consultant. You could be, let's say, an expert in a field, in a certain matter that you tend to be gotten for. So probably you may even find that you may end up working even after your retirement age. So these are some of the opportunities that they may have. And by the way, usually we say that in case you find that by the time you're hitting this age, you are not stable, you feel like you're not financially stable, or you feel like you still are not ready for your retirement, consider working again, because that aspect could actually improve your life. Of course, work has a social benefit as well as also the economic benefit of it all. So that is just as a nutshell what our life stages are, how to manage your financial wellness within that. But today, I would want us to consider now on the next level when it comes to financial wellness about investments, because that is the most important thing. So as a takeaway, before I invite Paul to the next conversation, one of the things that we need to all know is how much was coming in and what is going out. So you need to proactively manage your income and expenses and also track them. Building a safety net is key. We have learned that this is one of the things that you need to have currently as a need and not as a want. And the safety net basically is supposed to help you for during the bad times, or in case there is some huge outlay of money that is required for you to be able to develop yourself or grow yourself. So ideally, a good safety net would be a good investment plan, a good saving plan. It can be done through your circle, can be done through your bank, can be done through some of the investments like a money market fund, which is at the lowest risk possible, or a government bond best. Essentially, just build a safety net that you're able to liquidate in case of an issue. Of course, investment is key. Invest is key because that is going to help you in your future in terms of revenue streams or supplementing the income that you already have. So, and investing could also mean that invest in a business. So for people who are employed, I think one of the things that we've seen is that when you hit retirement age is when you want to go and start a business, which unfortunately, most of the time, they don't live past the second year. So what do you do? Start early, start in your 50s, start in your 40s, that business that you would want to invest in. So by the time you hit retirement, it can be your other thing that you do after you have retired. Of course, the last one is manage your health. Health is very expensive in this country. If you're able to manage your health, if you're able to live healthy, if you're able to take care of your health now and just proactively go to get checked, it will help in terms of the quality of life later on in retirement. So that basically is my comments from today's session. I know Paul is waiting up to start on the investment, but in case you have any question, you can ask.
Hello, Martin. There's a question from Deborah on
Sorry,
financial
yes,
literacy.
Joyce, just give me a second.
Yes. There's
Sorry?
a question from. Can you hear me?
I can hear you.
There's a question from Deborah, and she was asking if you can be able to explain a little bit about employee matching your retirement contribution, as these days payslips shrink, that there is little left, if any. So you can just respond to her. Sorry, from Irene, not Deborah.
Okay, all right. Let me see whether I can get that question. So she asked, okay, so now she says, Deborah, financial literacy is very much lacking in our population and should be propagated like fighting a plague. Poverty after retirement is a major issue. Probably missed that question. Joyce,
It's from Irene G. Yeah, could you please talk a little about employee matching your retirement contribution?
Okay, all right. Now, that talks to your retirement plan, and especially if you are employed. When you talk about retirement plans currently, what we have two levels of it. The first level is the mandatory one, which is the National Social Security Fund, or what we call NSSF. And NSSF demands that we contribute 6% of what we are earning, and the employer contributes 6% of what we are earning, but both of them subject to a limit. And I think for this year it's 4,320 shillings. So maximum that the employer can do for you is 4,320 for NSSF and also for myself too. That basically should give you a revenue, should give you a certain income after you have retired. So if you look at previously, we used to contribute 200 shillings and the employer contributes 200 shillings. By the time you hit the age of 60, most of the time we go home with a check of about 300 to 360,000 shillings, which is not adequate to take care of your life after retirement. So most employers said, we're going to augment this, we're going to increase this one by giving you a voluntary scheme. So the employer creates a voluntary scheme, and the employer contributes, promises to make a monthly contribution. Now, for you, which is a percentage of your pay or a certain value. So most employers went for a percentage of pay. So they would say, I will contribute 10% of your salary every month towards your retirement plan. And for me, for you as a staff, I expect that you'll also contribute, let's say 5% or 10% towards your retirement. And this money is invested separate from NSSF. So it would go to a private company like ours, APA, who manages retirement schemes. And then this money is invested for you and it earns an annual return. Then that money will be given to you when you leave employment. So that's basically how retirement schemes work. Now, this time, like you said, the pay slips are shrinking. There's little left, as Erin tried to put it. There's little left. So if everything is going towards my retirement, how do I live my life now? Now, one of the things that I would say is that we have had quite a change, and we have to notify, we have to be alive to that fact that in terms of the deductions that are happening on our pay slips. But what does that mean? It just means that we have to take that proactive step to basically reduce our expenses one after the other. Because if we don't do so, then we run living beyond our means. And living beyond our means is very scary, because what that means is that every day you probably be living from hand to mouth, engaging in loans, some of them just taking loans to take care of living expenses and not for growth. So basically, such kind of a situation will drive you back to a hand-to-mouth situation, which we call the rat race, if you know, or ask your employer to give you a higher salary or look for more jobs. Maybe that's where we're heading. People have to have more than one job at any particular point to be able to sustain their lifestyle. However, if you have got not more than one job, then what you just require to do is that you need to start reducing some of the expenses and the lifestyle that you're actually living in. If you probably go to Java every other day, probably reduce it to one day. If you go and see people on Fridays, what you call the Members Day, every other Friday, maybe you just need to have it once a week or once a month or twice a month. Such kind of things is what you need to start considering what you're currently having. Other things, if you have more than one car, probably if you're living in an expensive house, so some of the things is just start to reduce expenses. But the hardest thing that you can ever do in this life, I will tell you, is to live within your means, because there's a lot of peer pressure. There's a lot of pressure from either your family or your friends or whoever you're living with to basically maintain what you have, or if not, become better. So ideally, Irene, it's a very hard situation when we have shrinking pay slips, but the cure to that is just basically reduce your living expenses one way or the other. So, what about a mortgage? Should I take a mortgage or should I rent? It's a very hard question, by the way. But I will let Paul take it and he will take you through that. Thank you.
All right, thanks, Martin. Maybe just before I get to my presentation, let me take the question about the mortgage. It's an interesting question, and I'm not sure there is a complete correct answer to that question. But I think it all depends on the level of interest rates that you get from one point to the other. So if interest rates are very high at one point in time, like they are today, I think today you went to the bank and you try to borrow, you would get rates as high as 21%. It might make more sense at that point to rent rather than to borrow. Basically, the way to look at it is just look at your cash flows and compare. Just the same way a company would look at the option of leasing or buying a building is the same way an individual should do the same. So when you're renting, you're leasing. When you take a mortgage, you're whatever. If you use your money to buy, then you're buying outright. So what is the comparison? What are the cash flows that go out when I'm renting? So I'm paying, say, 100,000 for my house every month. You can draw a straight line and see how much will that cost me. How much am I paying for my mortgage? So you can draw and compare and see how much is going out every month to pay my mortgage. And then at the end of your mortgage period, you can now sell your house. You have another cash flow that's coming in. You can actually do the comparison and see whether it is better to buy or to rent or to get a mortgage. Sometimes it's better to get a mortgage. Sometimes it is better to rent. The basic line is to look at where interest rates are, and that will be the key determining factor as to whether you take a mortgage. But if you, for example, are working for an employer who gives you a subsidized interest rate, then you would be leaving money on the table not to take a mortgage. So I have tried to answer the question the best I can. I'm not sure whether whatever, but it all depends on the level of interest rates, and that sometimes it's actually better to rent than to take a mortgage. All right, maybe now we can move on to talk a little bit more about the investments. But do we have any more questions?
Yes, Paul, there are questions from the chat box.
Okay, so let me talk about, first let me apologize for not being on camera before. I think it has nothing to do with the fact that I'm not as good looking as my fellow panelists. But all the same, I think I have fixed the technical issue, so you can now see me. Just to say also that it was interesting to listen to Martin's presentation on the life cycle, and just to note that I have been through the entire life cycle. So I have a lot of experience in terms of that, but even then I have had some very good lessons to learn from that presentation. In particular, that as you get older, health becomes a very big priority to you, and it is important that you look after your health throughout your life, but even more as you get older, because it becomes a very big part of what you will spend on. So let me now get into my part of the presentation and just talk about the Apollo Asset Management Money Market Fund. So first of all, let me explain what a money market fund is. It's actually a pool of investment. It is a trust, and a trust is a very strong word. It suggests that it's built on the basis of trust. So we have a trustee who holds this money separate from ourselves, and we as Apollo are just the promoters as well as the investment manager for the money, but the actual assets are held separately, which guarantees you that even in the event that unlikely scenario where Apollo had anything bad happen to it, your money will still be secure. And the only risk then is the underlying risk of the investment. So it's a pooled investment that provides you with security of your money. And I think security is a very important aspect of a money market fund. It enhances your diversification. So if you remember the times of Chase Bank and Imperial Bank, where people lost quite a bit of money, when you're in a money market fund, the chances of that happening are very well reduced, because you are now spread across quite a number of banks, and also banks that have been effectively vetted by the investment manager. So the chances of an inferior bank or chase bank scenario happening is quite remote. So you are able to achieve short and long-term investment goals using your money market fund. So we say, that one of the important characteristics of a money market fund is that when you want your money, you will get it. I think the time frame is 3 days. So within 3 days of you saying, I need a withdrawal, you will be able to get your money. That is unlike most other investments. Even with a bank deposit, you will have to wait until the maturity for you to get your money back. It also has the advantage of very low entry level, only 1,000 shillings. So you have no excuse, those people out there. And then I have already spoken about the quick access to money, 48 hours. And then you can earn a yield as high as 11.32%, which is the current yield of the Apollo Money Market Fund. You can imagine earning 11.32 from a call deposit, because you can equate it to a call deposit because you have that 48-hour redemption period. So if you compare with most places, it's unlikely that you will get that. And we also mentioned that you can use a USSD code for ease of investments, and we are looking to enhance that to also the smartphone capabilities, which we hope we'll be bringing to you in the near future. So maybe let me just also give it a more practical perception to the money market fund by answering the question, when can I use a money market fund? So going back to Martin's presentation, he spoke about emergency funds. If you need money for emergency, you need to save an emergency kitty in the event that something happens and you might need the money. Either you have been retrenched or you have someone who is sick in the family and didn't have health insurance, or any kind of emergencies that we have, then the money market fund would be ideal because you're able to reach your money as quickly as possible. The second very important use of the money market fund is a place to park your money, whether it's in a brief period. So I'll give you an example. You owned a piece of land and you sold the land. If you put it in the same account as you put your normal money, there's a very good possibility that you will come 3 months later and realize that you have already used some of the money that you used from the proceeds of the land. So it is important to separate it so that you don't say, oh, we sold this piece of land, but I don't know what I did with the money, because slowly by slowly, if you don't plan for your money, the money will find a plan for itself. So the money market fund is a very effective way to separate your money from your daily cash and also earn some level of interest out of it. So if you've sold some piece of land even before you decide what you're going to do next, put it in a money market fund, let it earn you some interest in the interim. And when you decide what you want to do next, it will be readily available for you within 48 hours. So that's another very important use. But also finally, in Kenya, we have a very unique situation. The inflation rate in Kenya is 3.2% today, but the money market fund gives you 7.3%. Ideally, in most countries, you will not use your money market fund for long-term savings because it will be eroded by inflation. But in Kenya, we are at a unique situation where you can actually even use your money market fund for long-term savings, because historically they have been significantly above the rate of inflation, and therefore you are having real growth on your money over that over that specific period. So, and on top of that, even as you use it for long-term investment, it also has another important feature, and I think we talk a lot about compounding, interest compounding. The money market fund gives you compounding on a monthly basis. So every month you earn the interest, the interest is then reinvested to earn more interest, and that then increases your money quite fast in terms of the effective investment. So that's another very distinct advantage of the money. If you invest in a bank deposit, the bank deposit, you will earn your interest after the 3 months. If, for example, it's a 3 months deposit, and only then can you then reinvest the interest into the new deposit. So money market funds have those kind of advantages, and you can use them both for short-term as well as long-term investment, and as a place to park your money and separate it from your ordinary spending money, but also as a place to use to put your emergency money in the event that you need to reach out. So with that, I think I can stop there and perhaps hand it back over to Cynthia to take us through the Q&A.
Thank you very much, Paul. We do have several inquiries which have come in via the chat box. And allow me to start with one where someone has addressed this question directly to me. And this person is asking, maybe just make a comment about, in today's world, investing is no longer just about returns. It's also about impact. More investors are looking for ways to align their money with their values through ESG. What would be your comment about this? How do we invest while still adhering to ethical considerations and opportunities? Basically touching on ESG investing.
Hi, Paul. Sorry, we can't hear you. You're on mute. Hello, Paul. Please unmute.
Sorry, we're not sure what. As we give Paul time to come back, maybe we can channel this question to Martin. We have a question in the chat box where a member is asking, just a minute, I'm trying to trace. Does APA have the option where you save for a given period and earn money at maturity, something that works like a life cover? Maybe Martin give a comment on the same. Can have a confirmation as to whether we are audible.
Cynthia, Paul is on mute.
Oh, sorry.
Okay, Paul.
Can I repeat my answer, or did you hear me?
We didn't catch you. Maybe just walk us through the same.
Hello?
Yes, Paul, the audio is a bit shaky, but you could come again in terms of your response.
Sorry, Cynthia, can you repeat that, please, if you don't mind?
We did have a question coming in where a member was asking, in today's world, investing is no longer just about return. It's also about impact. And more investors are looking for ways to align their money with the values through ESG. So maybe give a comment as to what would be the ethical considerations and opportunities while doing ESG investing.
Yes. So I think you need to look at investments or in companies or investing in companies that are ESG compliant. And quite a number of companies today, including the likes of Equity Bank, KCB, Safaricom, and many of the banks in our markets today actually issue an ESG statement and look at what they are doing to improve their environmental, social, and governance structures to ensure that they are compliant. So it is important that as investors, we also bear this in mind and be prepared to commit our investments to where we are having a positive impact in the world. Thank you.
Okay, thank you for that response. Another question, is it advisable to invest in government bonds now, given the political situation in Kenya right now?
Thank you. Yes, I think it is still advisable to invest in government bonds. I think there is always the worry that the government will default and because of the political situation. But when you look at the current environment, one thing that has happened is that just the other day we got a credit rating which was upgraded from negative to positive by Moody's, which says that Kenya's financial situation is improving. And it is improving because we were able to pay off the Euro bond that was due mid of last year, or refinance it, so to say. And therefore, our outlook in terms of Kenya's ability to repay its debt, both domestic and locally, has improved. But also to mention that it is very, very unlikely for a country to default on its domestic debt. There is a possibility of a company defaulting on its foreign debt, mainly because, if you think of foreign debt, you have to get those dollars to pay it back. But with domestic debt, the likely scenario is things like what we've seen in countries like Zimbabwe, where they have effectively printed money and been able to service the debt. But the implications on that are then that you will have a higher rate of inflation, which will then erode the value of the bond that you have invested. So that is the risk. But the possibility of a default on the bond is unlikely. So I would encourage you that bond investments at the moment is still a lucrative investment option, despite the fact that interest rates have come down. But also the fall in interest rates is also a reflection of the reduced risk.
Thank you, Paul. We have Steve who is asking, can I use my money market fund to access a bank loan as a security?
That's a good question. I'm not sure I have the answer for that, but I think yes, it is possible, and I think I'm not sure whether you can actually use the current situation, but it is something that we can create partnerships with different banks so that they can be able to accept money market funds as security. In my opinion, it should be very, very possible, so long as there is an agreed arrangement between the money market provider and the bank, and the bank is comfortable with the money market fund as security. I'm not sure whether it's happening right now, but it's definitely a good idea, and it's something that should be looked into. So that, but however, let me say this: it really doesn't make sense to do that, because because the money market fund is so liquid, there is no need for you to give that money to go have your, because you probably borrow at a higher rate than what the money market fund is paying you. So there is no logical reason, and you are effectively borrowing your own money, and you might as well just liquidate your money market fund and use it for what you want to do, rather than use it as security and borrow. It doesn't make sense to do that with a money market fund. especially because bank interest rates will be higher than the money market rate.
Okay, thank you for that response. Before we take the questions from the members who have raised their hands, an interesting question here is, one of the biggest concerns for any investor is inflation, the silent killer of purchasing power. Is there a way to beat inflation, and how do I do it?
Yes, okay. So yes, there is a way to beat inflation. And I think we are, as I said, mentioned earlier, in Kenya, we are fortunate that probably because of the government's appetite for debt and the government borrowing more than it really should, or depending too much on borrowing, has resulted in a situation where interest rates are quite high relative to inflation. So if you think of Kenya today, the risk-free rate represented by the 91-day Treasury bill is 9.1. Inflation is 3.2. That is not typical of most economies in the world. It happens in mainly African and third world countries. And therefore, you are able to beat inflation even with a money market fund. But in real sense, what normally happens is that in times of high inflation, people tend to move to real investments other than money investments. So people would probably look to buy property, to buy shares, because then those tend to move in line with inflation. So to be able to beat inflation, then you would need to look at real investment. That is not that situation is not where we are in Kenya today, and therefore you are able to beat inflation even with bonds, treasury bills, bank deposits, money market, and otherwise. I think I remember one time I went to Zimbabwe, and I used to work for Old Mutual, and we had gone to Old Mutual, Zimbabwe, and they had Mercedes-Benz cars parked at the basement. And we asked them, what are these for? And they said, well, these are investment, because inflation was so high that if you bought a Mercedes, you could sell it for double the price in a few months or in a year's time. So an interesting scenario that you need to look at and see what are the options available. Thank you.
Thank you, Paul. We circle back to the question I had presented to Martin. We have a member asking, hi, does APA have the options where you save for a given period and earn more at maturity? Something that works like a life cover.
Okay. All right, good. Yes, we do. This, I think, is one of the building blocks for most of the life insurance policies, that they allow you to save at least now on a monthly basis with a given timeline within which the scheme, the policy that you have should mature. So we have two types of policies. One of them, what we call an endowment plan. And here we basically allow you to save on a monthly basis, and we still cover you in case of death or disability or critical illness covers. So all these things are basically some things that you can be able to get within that particular point in time. The other thing is that the other cover we have is where we bring in as an investment, what we call the wealth builder, allows you to put in a fund right now and also keep adding to that particular fund every particular year. Well, it still covers you towards that. Now, with the wealth builder fund, unlike the first policy, is that the wealth builder gives you a return on an annual basis. So you'll be seeing a return, let's say 10% or 11%, depending on what has been declared. So those are the two main ones that allow you to just save up to a certain point for maturity. The other one would be your pension or an individual pension plan, which has got many tax incentives in it. Whatever you're contributing basically is tax-free, up to 30,000 shillings now. If you're to get the money after retirement, you can get it tax-free. So, and it also gives you an annual return towards that. So basically, that's another plan that you may consider when you're looking at it. And then the last one now, as Paul has been speaking, is a money market fund where you just put in money. It doesn't have a maturity date, but is easily accessible as at when you want. So it's very liquid. And that basically does not hold your funds to anything or to any lock-in period, as I would say. So those are the two main ones those are the three main products that we have within our ecosystems that can allow you to get that. So, and basically by the end of this particular session, we'll have shared our contacts so that at least you can get in touch with us and we'll get a financial advisor to speak with you and just get to know exactly what you need. Thank you.
Thank you, Martin. Interesting that you mentioned a financial advisor, and I pose this question to Paul. What should I consider investing directly, or should I consider an investment advisor? What would be your take on this?
Very good question. They say a doctor does not treat himself or his family because what happens is that your emotions will cloud your judgment. So in my recommendation, I would say that you need an investment advisor. Even myself, I use an investment advisor. Even though I've been advising people for more than 33 years, I still go and look at for advice from somebody else because that helps us to remove the emotions and to be objective, but also to get a second point of view. It's always important. There could be something that you have not seen, that you have overlooked, that the investment advisor will give you a perspective on.
Thank you, Paul. Thank you for that. Still touching on the money market fund that we offer, we have a member basically asking on the money market fund, why 1,000? Why not 100 shillings as the low investment minimum? Paul, if you're speaking, we can't hear you. You're mute. Paul, we have lost you again. Okay, apologies for that. Trying to see whether we have any questions that have remained unanswered, and we do have several. As we're giving Paul time to come back, I'm not sure what the issue is.
Hear me?
Yes, Paul, we can now get you.
Hello?
Yes, Paul. Sorry, Paul, if you're speaking, we can't quite get you.
Hello?
Yes, Paul, proceed.
Did you hear me or was I mute? I think I might have answered.
You are either muted or you dropped off. We didn't quite get you.
Okay. Okay, so the question was about 1,000 shillings. What I was saying is that we have actually reduced, and you will find that we are the money market with one of the lowest limits in the market. Some of them have a minimum of 500,000 shillings to be able to invest in a money market fund. And we have tried to do this so that it's economical for both for both the investor, but for us as a provider, so that the expense ratio that we have makes sense to everybody. But as I said earlier, as technology develops, maybe there will be opportunity to reduce that limit to lower levels. But you will find that 1,000 probably is one of the lowest limits in the market.
Okay, thank you, Paul, for that. I'm going to pose two questions, or rather concerns, which I think you can handle concurrently. We have a sentiment from Christine, and she's basically articulating that I have come across other MMF in our country which have an app. The app allows someone to invest for specific multiple goals. Can Apollo look into giving us such or even more? A different concern from a different member, can money market fund be considered in Ugandan branch too? Maybe just a comment on the same, Paul.
Okay, those are both very good suggestions. I can confirm that yes, that is some work in progress in terms of providing the capacity to enable you to build an app which will enable you to invest with certain goals in mind, so that should be coming through in due course, and hopefully before mid of this year we should have be launching something to that extent. I think also the suggestions about Uganda is something that we will take in mind. We will take that up and see whether it's possible to also expand to Uganda with the money market fund.
Thank you, Paul, for those sentiments. We are quickly coming to the end of this presentation. We were supposed to wind up at 9:30, but two closing remarks, or rather questions, which I will also request Paul to handle, is a member basically inquiring on why do we have the differing rates between the various providers. We have some MMFs giving as high as 14%, while others giving as low as 9%. So maybe you could explain on that difference. And still on the same, we have a concern from Simon, who basically asked, is my deposit guaranteed? Because your website has a disclaimer on MMF.
Okay, two very good questions. So to answer the first question, the difference between the yields in money market fund come from two levels. The first level is what we call reinvestment risk. So for example, if you had invested your money short term and you are reinvesting it when it matures within the fund, and the rates have fallen at that point, then the rates will be lower. It could be that somebody had invested longer term, and therefore, when it comes to the maturity, they will find that their investment will even be lower at the point when they come to reinvest. So it's got a little bit to do with the timing of cash flows as the reinvestment risk aspect of it. It's also got to do with the size of the funds. Sometimes you would find that a fund is very small and very agile and has only started at a time when interest rates were high, and therefore they are enjoying that advantage of high interest rates. It also has to do with the risk of the underlying investments. So if your investment, some funds invest in bank deposits, some in treasury, some in commercial papers, and you will find that the higher the risk, the higher the return that you get. So it's important to bear that in mind. What you really need to look for is consistency in the return of your fund. Not necessarily the one that gives you the best, but the one that gives you a consistent return. And I think we as Apollo, we look to do that in terms of our investment by both managing our reinvestment risk, but also managing our credit risk of the underlying investments that we invest in. Which brings me now to the final question about the disclaimer. That yes, the concept of the money market fund is that there is an inherent, it is designed on the principle that your 1 shilling will always be 1 shilling. It should not really go below the 1 shilling. And even the pricing mechanism that we do, we don't price the money market fund. If you look at the equity fund, the balance fund, and the other funds, they give you a price which could fluctuate. The money market fund gives you a yield, which suggests that you will always earn, you will always have your 1 plus a percentage on top of that. However, in the event that the underlying investments have a problem, and there was a history of that, I think, in the past, where some money market funds had invested in an Akumat commercial paper, and therefore there was a challenge with that. So if the underlying investments have a problem, that is where you would have a problem. And that's where now you leave that to us to do the analysis, the credit analysis. And we do credit analysis on all the underlying investments, including the banks. We look at their balance sheets, and we are able to analyze and see which are the strong banks, which are the not so strong banks. And therefore, we are able to manage that credit risk to ensure that your 1 shilling will stay as 1 shilling. Thank you.
Okay, thank you very much, Martin and Paul, for taking those questions. Clearly, we are constrained in terms of time, but we still have some various concerns from the members. We take note of the request to have an app to facilitate the money market transactions. I can see comments from Remy. I can see comments from Daniel. This recording will be shared to the various participants. So we have taken note of all the concerns that have been raised. We do thank you for the traction that this conversation has gained. We see that there are very many questions coming in terms of the investment considerations. Should I invest by myself? Should I go through a broker? etc, etc. So this is to give you the assurance that our scope of service extends beyond this webinar. We remain available to address the various questions, concerns that you have, and we shall be in touch once we share this webinar recording to yourselves as well as the presentations. We will engage in further conversations offline. So just to issue the final remarks before we adjourn to attend to other matters of the day, if you paid very keen attention as Mr. Martin was walking us through the various life stages, you realized the depiction was, they looked like gears. So this basically tells us that money is the oil in the engine of life. It is not the be-all to everything, but it certainly makes the wheel of life go along smoother. Money gives you the freedom of choice. How you do it, how you build your pot is you invest wisely, you plan and you keep investing wisely, be it on the retirement savings, be it on an MMF fund, be it on a life cover, etc, etc. So we as APA Apollo Group, we have all these solutions and we remain available to address the various questions that you will have. So I will say thank you very much for attending this webinar. We look forward to having more engagements in future, and we will invite you so that this conversation remains an ongoing thing, because learning is a process. There's never a stop to it. And clearly there is much to be learned. So thank you very much to all the participants who have made this webinar successful. Thank you very much to Mr. Matai for giving us that insightful breakdown of the life stages and the financial expectations. Thank you, Paul, for helping us to understand how to grow and manage our wealth and giving us the very useful insights when it comes to the investments. For you, the various participants, thank you very much for your questions. Thank you for making this webinar as participative as it has been. And we look forward to engaging in person. You can reach us via our emails. You can come into the various offices, regardless of what location you are at. So asanteni sana, and we are free to basically live at our own pleasure. Thank you so much and have a good day ahead.
Thank you, everyone. Oh, well, that went well.